What's up, everybody? Today on the Frame of Mind Inc. podcast, we are talking stocks, trades, and investments with my man O. So get your pen and pad ready because it's going to be another great stock, trade, and investment session coming at you for FREE. Are you ready? I know we are. Frame of Mind Inc. podcast begins and starts right now. Get your mind right. Get your mind right.
It's a frame of mind.
Ladies and gentlemen, welcome to the Frame of Mind Inc. podcast. This is your boy Simbawi Nibaye Jr. and my man Omar Williams. We call him O. Oh, you there, my brother?
Oh no.
Right, we're gonna get O back in a minute, but he's having a little technical difficulties, but we got him coming back. Welcome again to the Frame of Mind Inc. podcast. Today we are talking about stocks, trades, and investments. This is what we do every first Wednesday of the month. So welcome to the month of March to get your tips and tricks, should we say, respectively, from my man O. But before we do that, it's Affirmation Wednesday. So you know what we do. We got our affirmations in and out the way. So if you get your pen, paper, pad, tablet, or whatever you use to write these things down, or if you got it memorized, let's hit these up real quick and get this thing moving. Are you ready? Let's do it. Today will be a good day. Today will be a great day. Today will be an awesome day. Today will be an amazing day. Today will be a phenomenal day. Today will be stress-free. Today will be a stress-less day. Today I will become better than who and what I was yesterday. Today I will overcome all barriers that want to block my progress. Today, all circumstances, issues, and situations will work in my favor. Today, all things will line up for my good. I am a go-getter. I am victorious. I am triumphant. I am an overcomer. I never lose. I either win or I learn. I take authority over this day. I will dominate this day. I will conquer this day. And everything I have spoken into this day will happen as I have affirmed, because I am more than a conqueror. Let's get it popping. There's my man O. There he is.
Man, I don't know what you were dealing with, but you made it happen. You was like Jordan in the fourth quarter. He's got will to win, man.
Man, look, when you do, a sound and things going wrong, you got to improvise, man. So I learned how to improvise and make things work. And when things go wrong, you don't panic. You just improvise. You just kind of cruise that thing on down until things get right. So it's all good.
Yeah, it was
brother.
looking bad, man. But yeah, it's funny how I got my Sixers on tonight because I gotta check the game out. So I'm like, I'm gonna run through this so I can get to the game. And then this happens, right? And I'll be starting.
Oh man.
Well, let's get it going, man. You introduced everything, right?
Yes, sir, man. The show and the floor is yours, my brother.
All right, my man. Appreciate you. So we're gonna get through this, and I'm gonna run through it. Halfway through, we go to a commercial. So tonight we're gonna talk about 401k and how to maximize that. So like everybody has one, or there's a lot of people who maybe not have one, but if you work at a company that offers 401k, it used to be pensions. Now they offer 401k. A lot of us out there have one. So tonight, if you remember some shows back, I showed you a little plan how to really like kind of not trade it, but like it protect yourself from getting hit from bad times, such as we've seen these last couple weeks. So we'll get to that at the end. I'm gonna run through this. Like I said, I'm trying to catch my boy tonight. But get a notepad, paper, pen, whatever you need. I'm gonna run through it hit by hit. Here we go. So, how to build your 401k. First of all, you want to start by saving. Now, if you don't have a company, you can get your own. So you can save in a tax deferred retirement account as soon as you can. Age does not matter. Okay, to get more bang for your buck. And with that, like, so you can invest in. So say you just go to E-Trade or TD Ameritrade, you can get an IRA or a Roth IRA. The difference between the two is the Roth, after 59 and a half, they don't tax you when you withdraw any money. With the IRA, after 59 and a half, they tax you at your current income. Okay, that's the difference between the two if you were to do it on your own. Now, for those who have a 401k, it's like having a Roth IRA. You won't be taxed after 59 and a half when you withdraw money. Okay. Next, start by saving at least 1% of your pay. If that's all you can afford, start somewhere. I know that sounds small, but at least something is better than nothing. Okay. Next, save for retirement, even if you think it's too late. So if, say you're 45 and you want to work another 20 years, start there. If you're 50 and you're working another 15 years, start there. It's never too late to save money and have it compound for you over time. Again, 15 years is better than 0. Okay. Next, and this is a good one. Save at least the amount that your employer is going to match. Otherwise, you're just throwing free money in the trash. So what that means is, some of you may know what I'm talking about. Your employer may match you up to whatever percent. So whatever percent the employer matches you at, I've heard more like the most I've ever heard was 6%. Some of them dialed it back, but if it's 6%, you invest 6%. If they match 5, invest 5. If they match 4, invest at least 4. Do the at least. So like if it's 6 is their top, at least do that. If it's 7, at least do that. That's just free extra money that they'll match and put in your retirement account for you. Okay. Now, aim to put away 10% of your income up for retirement each year. Okay. So again, if you're doing it on your own, like say you're an entrepreneur, business person, you make $100,000, aim to save $10,000 for that year. And for people who work, as we increase our raises, so say you get a 2% raise, 3% raise, 4% raise, take some of that percentage and add it to your retirement account. Okay. You want to aim to build a bigger nest egg as time goes on. So just to give a, just a ballpark, or not a ballpark, but to give you a blueprint of where to start, at least you want to save up to 10 times your annual income. Just for easy numbers, annual income is $100,000. You want to get eventually your nest egg up to $1 million. So let's go lower. So if it's $50,000 a year, you want your nest egg to at least get to $500,000 at the least. Okay. This is just starting to build it. Okay. And just remember, as we get older, and as we know, we've been hearing it for years. Like I said, me and my brother right here, we're not that older yet, but I've been hearing since I've been 20 that by the time I retire, there won't be any Social Security left. I've heard that, so by the time I retire, they're going to be hemming and hawing on trying to figure out how they're going to pay older folks at that time. So get it right now while you can and while you're able. Okay. Next, here are some 401k strategies. Okay. Again, take notes. This is some good information. Okay. First, you want to come up with a plan, whatever that plan is, whether it's aggressive, not as aggressive, or even conservative, right? Know what you're doing and why, and don't invest blindly. Okay. Hoping that it'll all come out well in the end. I've done that. I do that with my trading and investing now. Like sometimes I'll take a shot in the dark and I'm hoping that it had, and that's a horrible way to do it. And you definitely don't want to play with your retirement like that. Okay. So you need to know where you are located. If you're 20 years old, 30 years old, in your 40s and your 50s, you kind of want to know what you're doing at that time. What's your plan? What's your strategy? Are we aggressive? Are we not less aggressive? Are we kind of in between? We need to know these things when we get into this stuff, okay? Establish realistic expectations, okay? And then like you'll be able, like, as you, the ones who know about 401k, there's funds you could pick. So when you establish these expectations, realistic ones, you'll pick the funds that are meet the goals you have. And now they got software and all kind of stuff that'll, you just plug in your age, the year you want to retire, and the amount of money you need or want to have, and the computer, like the algorithm, will tell you exactly what you need to do. So that's a good thing about having this plan together. Okay. Um, next, remember this, and got to tell a lot of people this: the higher the risk of the fund does not guarantee a higher return. As we know, COVID hit. If you were in high risk funds when COVID hit, your account saw all of that drop. It absorbed all of the crash. But if you were in less riskier things, it didn't absorb as much. Okay, so if you were older and you put your funds in something that was a little bit less risky, you might have took half the hit or a third of the hit, which is a good look, right? Okay. Avoid funds that have dramatic up and down swings. Now, in your 20s, you could do this and you could take that chance. But when you're starting to near retirement, you want to get it in something a little less volatile. Okay. You also want to invest in a mix of asset types. Basically, and I'm gonna make this simple. There's stocks and bonds. Okay. Bonds are less risky, stocks are risky. And all these funds pretty much have a mixture of stocks and bonds. Um, a good portfolio, they say a lot of times you're 60-40, 60 stocks, 40 bonds, or it's 50-50, 50 stocks, 50 bonds, and so on and so forth. 70-30, that's really risky. 60-40 is mediocre. 50-50 is perfect for an older person, right? You see what you want to do there, okay? Also, you can find professional help to help you choose the investments. And if you know anything about your 401k account, you go on there and it's so much information, so much education. It's so many things that help you actually pick what you want to do. Okay. Next one. How to get the most out of your 401k retirement plan. Okay. Hold on, brother. Okay, I'm good. First, what you want to do is contribute enough to get the full employer matching contribution. I talked about that before. If the employer contributes 6%, you contribute 6%. 5, you do 5, 4, and so on. Okay. Next, use the educational tools. I talked about this too. Use the educational tools in retirement planning that's on your site or whatever company that your company uses. Use that information. It's helpful. Trust me, it is. Even if you don't understand, a lot of times they put it in graphs and they'll show you the percentage of gains over the 20, 30, 40 years or however long it's been that fund has been in existence. So really look at that stuff. Get educated on this stuff before you just go clicking things. Some companies make it really easy. They make you pick between 1 to 5, 5 being aggressive and 1 being conservative, and they say, all right, between these ages, you want to do this. Between these ages, you want to do that. And they make it really easy. But usually what I find with those kind of accounts, you don't have that much control. Once you pick, you kind of, to make a change, you got to wait a lot of days to even change it back again. So, okay. If you're married, you want to plan jointly with your spouse to get the maximum advantages from both your plans. Like I said, one person may have more flexible plan, the other one is a little bit more tight. You might want to kind of use the one that's more flexible to make the most changes in, and kind of put the one that's not as flexible in a fund that you'll be good with the gains. You may not get all of the gains, but you'll be good with it, and you don't have to touch it, and you just let it go on autopilot. Okay. Take any company stock. This helps too. company stock that your employer gives you, but don't invest your own money in it. Okay. So, like, if they're offering you stock, take it, but do not buy with your own money, because what can happen is company go out of business. Oh, they go bank. Like, a lot of things can happen, and now you got your money tied up in it. Okay. Now, if it's stock they're giving you, take it. It's no harm, no foul. Okay. Now roll your retirement money directly into a new tax deferred account when you change jobs. This is big. A lot of times we change our jobs and we don't roll it over. We just let it sit there and it's not working for us. And you're working again and working and working and working, and you're not compounding that money that you made from the last job. So if you change your job, roll that retirement plan over into your new company's 401k plan, and do not cash it out. We'll get to that later, though. Okay. Now, this last point, and I'm ahead of myself, but don't take a hardship withdrawal or a loan unless absolutely necessary. This one's big. A lot of people touch their 401ks. Now, I was taught, if you're going to touch it for a big purchase, such as a home. Okay. But that might have been the only purchase somebody's ever told me to use it for. We'll stop right here, brother. We can do a commercial break right here, brother.
All right, that sounds good, brother. Good info, good info. I got maybe a couple questions, but I'm gonna save those for the end.
Okay.
So I hit a quick commercial break. Coming back, my man O dropping knowledge on the 401k plan. Frame of Mind Inc. podcast. We'll be back in a few. Are you looking for an apparel company that's positive, uplifting, and truly cares about you? Then look no further. Frame of Mind Inc., an apparel brand company, impresses on individuals to think positive thoughts, say positive things, and do positive deeds. Get positive apparel such as t-shirts, hoodies, and wristbands for children, teens, and adults in various colors and sizes. Customized services include logo and t-shirt design, screen printing, and embroidery for individuals, families, schools, profit, and nonprofit organizations. You can reach Frame of Mind Inc. at 302-689-3499 or visit their website at www.frameofmindinc.com. Frame of Mind Inc. Think it, speak it, achieve it.
It's a frame of mind.
And just like that, we are back. So I'm gonna let my man O. We're talking 401k today for the Stock Trade and Investment podcast. So O, take it away, brother.
All right, we'll continue on. So we finished with my last point I made was don't take any hardship withdrawals or any loans unless absolutely necessary. So that's going to be my next topic. Please tune in. If you're listening, listen to this part really, really good, because it's easy to just take money and you pay off small debt. I get it. It makes this like you're sitting looking at $300,000 or $600,000 and you're like, oh, I could take 30 of that out or whatever. And you got 20 years left to work. And I understand what it looks like, but it's not a good idea unless it's a big purchase. Okay. Make taking money out your 401k retirement account your last option. Okay. The consequences of early withdrawal from your 401k can hurt your current tax situation. So, like, you'll get taxed now, like as income, and it can affect your future investments. Right. Keep this in mind. Keep these points I'm about to tell you in mind as we go along. Okay. First, if you have to take money out, calculate how much tax you'll owe on the hardship withdrawal. Okay. Before you withdraw the money, you'll owe income tax plus a 10% penalty on an early withdrawal from your 401k account if you're under 59 and a half. Again, after 59 and a half, you don't have to worry about taxes. And you still don't want to take, we'll get into that. I don't want to get ahead of myself. If you're under 59 and a half, your employer withholds some taxes, but you need to make up the rest. Okay. Check this one out. If you withdraw $10,000 at the age of 35, This will result in a loss of $210,000 by the age of 65. And that's only assuming that there's a 9% rate of return over the years from the age of 35 to 65. You could play with those numbers. It could be more percentage, which would be more of a loss. So it could be a little bit less. But at the end of the day, at the rate of 9% return, if you withdraw $10,000 at 35 and 30 years later, it was a potential loss of $210,000 that could be in your account. That's too much money to waste, too much money to miss out on for just a $10,000 withdrawal of your 401k money. Okay. Withdrawing money to help buy your first home can be good. Okay. Especially if it's early in the year when when you get tax breaks from home. So you get tax breaks from home ownership, and it helps offset the additional taxes you pay on your distribution. So again, this is why, right? You buy a home with that money, a house you get tax breaks on owning a home, and it offsets that cost. But again, like I said, before I even knew some of this stuff, the first thing people would tell me was only withdraw money to buy a home, nothing else. Okay. If you borrow from your 401k, try to continue to make new contributions while repaying the loan. So what happens is when you borrow against your 401k, you got to repay that back like a loan. Now, people say stuff like, well, it's my money. Yeah, it's your money, and you're repaying yourself back. But like you're missing, like I said, if you borrow 10,000, you're missing out on 210,000 in 30 years. Imagine if you borrow 20,000, 30,000. You do the math. Okay. So yeah, if you borrow from your 401k, make sure you make new contributions, okay, while repaying the loan that you borrowed from. And this can kind of help you out, okay? Don't take a loan if you're likely to leave your employer before repaying it. Any unpaid loan balance will likely be taxable when you leave. And again, these accounts are so we can avoid taxable events. But again, you got to wait till 59 and a half, okay? But we don't want an account like 401k or IRA or Roth IRA to be hurting us tax wise. It's hustling backwards, for lack of a better way to put it. Okay. Hold on, brother.
You got it. Hope y'all taking notes. He's dropping knowledge on that 401k. And while he's doing what he's doing, I'll be honest. I was one of those people that was like, that's my money. That's my money. How come I got to pay it back? And I learned real quick how to adjust. That's all I'm saying.
Hold on, man. My computer, just when I was going to share the screen.
That's all right.
But my computer, you can still see me, right?
I can still see you, yes, sir.
All right, it's cool. All right. So now I got to do my Jordan move. Do my plan B.
You do your Jordan move. I'm talk to piece real quick. So look, number one, technology. It does what it does. It's just that simple. You know, there are times in life where you got the perfect plan put together. You like, yo, I'm about to knock this out the park. And something happens and you're like, no, not now. Guess what that is? That's a test. That is a learning moment to say, okay, what did I possibly do that could have caused this to happen? How do I resolve it? And how do I make it better next time? It's that simple. I was reading, I was listening to the audiobook. You let me know when you're ready, I was listening to an audiobook Sunday night. It's Lead the Field by Earl Nightingale. And one of the things he said, and I may not quote it all correctly, but he said this. He said, successful people are not successful because they don't have problems. Said successful people are successful because they found solutions to their problems. Just saying.
That's good stuff.
You know,
All right.
had an issue and a problem. He fixed it. We had an issue, a problem in the beginning. We fixed it. We didn't panic and go into panic mode. And he's like, all right, it's all good. But
Yeah.
you learn that over time. It's like if this happened 3, 4, 5 years ago, it might be a different story. But we've been there, we've done that. We keep it moving. I'm done.
And before I continue, just always have a plan B. Always plan for, like I said, I had to pull my notes up on my phone. So
There you go.
I'm gonna just read it from my phone because again, I don't know what's going on over there. Okay, so and last but not least, just managing your full. So once we do all what we talked about earlier, you want to get to the point where we actually reach retirement. Okay, and what do you do during the managing years? Okay, so consider keeping at least 1/3 of your money in stocks during your retirement years. Okay. Converting everything into a fixed income investment leaves your money vulnerable to inflation. We know about what's going on right now with inflation. I don't know if you've been to the store or trying to buy anything, but everything is through the roof. Gas, houses, food, everything's higher. So the whole goal of this whole investment thing, and I'm gonna deviate a little bit, but we got to try to beat inflation. That's the whole thing to keeping wealth. If you're not making more than inflation, your money just dwindles away. That's why they say it's not even good. Like you save to invest. You don't just save to save because if you just save money, not to do anything with it or just save and save and save, over time, inflation will dwindle that money down. Like so, what was $20 10 years ago is now worth $10, or if it 20 years from now is worth $10. So you just saving it, but investments can outperform inflation. That's why this point says consider keeping at least 1/3 of your money in stocks so you can outpace inflation. Okay. You can't ignore it. Okay. At this point, what costs $10,000 now when you retire will cost $20,000. People bought homes. My wife's grandparents bought a home for $3,000, sold it for $35,000. A lot of money, right? And they bought a small home in the 60s for $3,000. Okay, that's inflation. Again, establish realistic investment return expectations, such as no more than 6 to 8%. Okay, during your retirement years. Don't be lured into high octane stocks that may fizzle. Just keep, chugging at that 6 to 8%. You still want to make that after retirement. You want to set your situation up to where you're still making between 6 to 8% a year, outpacing inflation. Okay. Plan to withdraw when you're in retirement no more than 6 to 7% of your retirement account each year to reduce the potential of running out. We don't think about that part. Like, what if you outlive your money? We did something wrong if we outlive our money. We miscalculated. I'll put it that way. I won't say we did nothing wrong, but so withdraw 6 to 7% a year in retirement. Okay. So you don't run out, because with the money that's left, we'll keep kicking you back 8 to 9%. You skim off 6. Make another 8 to 9, skim off 6. And that nest egg never really has to move, right? Okay. Here's another option. Oh, back what you want. Oh, here's another option. You can consider selling your home at an older age, okay? And invest in the proceeds. It's another way we can, get ahead of not running out. Like you bought a home in your 30s, 30 years later it's paid for. You bought it for 200,000, it's now worth 450. That's 250 grand that you can go invest that money now and then skim off what? That's 6 to 7% off that on top of the 401k. So now you're getting 12, so look at that. And then now you have an income to live on. Okay. So now you can convert your home from income consumer to income generator. You can also rent it out. That's another option. When you get old, you can either sell it, invest the income, or rent it out when it's paid for. And then you rent something smaller. And again, last but not least, I'm not a fiduciary, I'm not a financial advisor, but if you have one, or there's one at your job or your company or your brokerage that you use that you want to get the IRA through, consult with a professional. Get somebody that can kind of walk you through it, and they can set you up. If you're 30, 40, 50, they'll let you know, look, this is what it'll look like in whatever amount of years you want to work till. I feel bad now because it's a lot of people. You're seeing some of it happening. Like if you go out now and you look at people working, a lot of people are older at Wawa's and Burger Kings and Targets and Walmarts, older than you've ever seen. You know what I mean? So we got to set ourselves up for when that time comes. You know what I'm saying? So that's my. Let me see if I'm still frozen. Oh, I'm not.
I got you good. I got you good over here. Yeah.
All right.
We I think we both got frozen for a minute video wise, but we're good. We're good.
Okay.
All right. So I got a few.
Yes, sir.
Actually, before I go, you done. You're good, right?
Yeah, I'm done with the presentation. I was just trying
Okay.
to. I'll tell what to do. I won't show it because it's still acting up. But go.
Gotcha.
Okay, I'm with you.
So just a few things. So when you were talking about the Roth account, you said at 59
And a
talking
half.
about 59 and a half, talking about age, right?
Yes, sir. Yep.
So in case you guys are out there saying, what's 59 and a half mean? He's talking about age. All right. So you don't get confused. 59 and a half, that's how old you would be.
And yeah,
for
that's
those
the
cycles.
yeah, like that's the age they will. After the 59 and a half, you won't get penalized. With a Roth IRA,
Right.
with a traditional IRA, if after 59 and a half, you just get taxed at your current income. So you get taxed at current income at that age. But anything before 59 and a half, no matter what account you have, there's a penalty coming with it. Okay.
I understood. Now, I too have been told that do not touch your 401k, should you have one, only for a big or major purchase. And I've only been told, me and my wife have been told that the house is the only one you should probably do that for. So I'm just concurring what O said. The house thing is what we've been told. He's been told that. I'm pretty sure others have been told that. So you might want to make sure you keep that bullet point down so it'll help save you heartache and pain down the road. Okay. He also mentioned, having to pay taxes on some of that stuff. So just on average, like most times the tax fees are between 5-7%. So if you're going to take money out to pay for taxes, take out 5-7% and just put it into an account. Just let it sit there. And when it comes tax season, you'll be able to have money already set aside rather than saying, oh crap, we owe this amount of money. Where are we going to get it from? Now, if you're well off, and I'm not saying even if you are well off, still set it aside because you just never know. You don't want to be wasteful with your money just because you're well off. You want to be very smart and do the right thing with it. But you're looking at 5-7%. You have something you want to say?
No, that's a nugget, man. That's huge. That keeps people, keeps people from getting penalized by the tax man, or you don't have the money. You know what I'm saying?
Exactly.
And like I said, you're more of an entrepreneur. You know what it's like to present your business money. You know what I'm saying? And
exactly.
So,
and as I've always said before, keep all of your receipts.
Yeah.
All of them. Trust me, we have been audited 2 years in a row.
Yeah.
And did not owe a dime because we kept every single solitary receipt. And we had everything to back it up, saying that everything that we paid for business-wise came from the business account. So keep that in mind as well. Last thing I'm going to say, you made a mention of we've got to beat inflation.
Yeah, that's pretty much how you generate and keep the wealth. You got to beat it.
The other thing you said investment can outpace inflation. I think that was probably, if you got nothing else out of what he said, Investments can outpace inflation. If you got nothing else, you need to run with that right there. Period. Anything
Even
else
if you're
got?
beating it by 1%, if you just beat it by 1%, you're winning.
You're winning.
And then you compound the 1%. Like that's the game. They're just trying to outpace it, because if you don't, it's gonna be like a pocket with holes in it. You know what I'm saying?
There you go.
So
Walking around with pennies falling out your pocket.
exactly. Thinking you saving. No. That thing is dwindling, but okay, I'm sorry.
Nah, you good. You good. Anything else you want to tell the people before?
Oh
we
man,
get out?
just yeah. So I'm gonna just give you like, so what you could do so to like stay ahead of it and not be panicking, and again, go back to some of my prior stock talks. I talked about the 401k like plan you could do of changing your account when this does this, but I'll mention it again. Basically, what you want to get a weekly chart to where every bar is a week's worth of data, okay? And then you want to put a moving average. Again, if you don't know what I'm talking about, rewind this part and start looking up what I'm saying, or go back to the show where I actually showed you what to do, okay? You want to get a weekly chart where each candlestick on the chart is worth a week's worth of data, and you just want to put a moving average on there, and you want to make it a 21 period moving average, okay? And what happens is when the chart's above that line, the moving average line, you want to be aggressive. When it goes below it, you can do what you want to do. You can go all the way conservative, or you can go mediocre. If you just do that, and like I said, I went through it over the years and showed people, and we just hit a moment 4 weeks ago where my plan, you would have reduced your account down to something more conservative about 4 weeks ago. Yeah, so it hit last 4 weeks of 4 weeks ago. It's showing you should have taken out of the aggressive stocks or aggressive funds and went to something a little bit more conservative. We haven't crossed back up yet, so I'll let people know when. But again, you want a weekly chart, a 21 period moving average. When it's above that line, go aggressive. When it's below that line or crosses below that line, and you want to pull it out. And sometimes some of the funds, once you make a change, you got to wait 30 days for a change to change it back. But that's fine, because this is a long-term situation. So, you know what I mean? So,
Right. Gotcha.
if you don't get it, just rewind that again, or go back and find it where I was talking about the 401k plan. I'm not sure what show it was, but
Right. And mind you, we've got back to 2021 of these investment, stock and trade talks. So just have fun and go look around and listen to some old stuff and then get caught up. All
Yeah.
right. Sound like a plan to me.
sound like a plan, man.
All right, everybody. We thank O for dropping that knowledge on the 401k. I was going to ask you a question, but I'm like, you know what? I'm going to say that for next time. That could be a whole other conversation. So I'm just going to hold that for now. Do that one later. So
Okay.
all of us here at the Fairmont Inc. podcast, thanks for joining us, everybody. You can always catch the replays audio-wise on Apple Podcasts, Spotify, and on Amazon Music. And if you want to catch the video replays, you can always go to my Facebook page to TK. You type in the @TK Billionaire, and it'll take you there. Or you can type my name in. I'll just spell it for you because you probably aren't going to get it, but it's TSOMBAWI. I'm the only person on Facebook with that name, so you won't find anybody else. Or you can also catch our replays on our YouTube page, which is Fairmont Inc. YouTube channel, and as well as LinkedIn as well, which would be my profile page on LinkedIn. So for all of us here, thank you very much. Guys, have a great rest of your week. And as always, continue to think it, speak it, and achieve it. And until next time, I holla. Thank you for joining the Frame of Mind Inc. podcast. And as always, here at Frame of Mind Inc., think positive thoughts, say positive things, and do positive deeds. As our tagline says, think it, speak it, achieve it. See you next time.
It's a frame of mind. It's what you say and what you do.
Don't forget to check us out on the web at www.frameofmindinc.com, where you can browse our online apparel store, listen to some of our original music and production services, as well as view our videos and projects we've done for our clients and customers.